Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Wednesday, January 24th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and I'll be your host for the next 30 minutes or so as we prepare for the next trading day to open. So far, futures looking pretty good. Let me give you those numbers. I'll start with the Dow, the diamonds, so I can get you the actual number right now. Diamonds right now up about 0.4%. We got the spider, S&P 500 yesterday closed at a new all-time high, and the spider is up another 0.5% this morning at the open. That is up to 487.43. We've got the QQQ, Netflix. We'll talk about that in a little bit, but Netflix coming through with their subscriber numbers. They actually missed on their bottom line. They beat revenues, but they crushed their subscriber numbers, I believe 13 million higher than expected from what I recall. I just saw a headline on that. But the QQQ, as a result, up about 0.8% this morning. So the QQQ doing well. And then we turn our attention to small caps, which are up 1.3% this morning in pre-market. Yesterday, not so great a day for small caps. Again, we'll look at those numbers in just a minute, but small caps did pull back a little bit yesterday, especially in the morning after gapping up. Didn't look very good. They came back, though, toward the end of the day, and now we're seeing futures up again this morning. So all in all, not bad. I believe we've now gone 4 consecutive days with higher highs and higher lows in the IWM, and that streak looks like it could continue at the opening bell today. So that'll be an interesting story to watch. I do also want to mention that we have our live trading room that starts at 10 a.m. this morning. If you are new to this show, or maybe just haven't tried our service, now would be a great time to take out a 30-day trial, because that will get you the next 5 trading rooms. We do these every Wednesday morning at 10 a.m. So a 30-day trial will get you 5 of these live trading sessions for free. The first one, again, starting in just under an hour at 10 a.m. Eastern this morning. So we'd love to have you there. Let's go ahead and get started here and take a look at the action from Tuesday. Saw the Dow Jones Industrial Average down about 96 points. That was down 0.25%. S&P 500, though, setting a new high, closing up 14 points to 4,864, getting closer and closer now to the 4,900 level. It's amazing. You get through these key levels, and then it seems like the next couple levels seem to go pretty easily. Well, 4,900 right around the corner now on the S&P 500. The NASDAQ 100 jumped 73 points. That was up about 0.4%, so outperforming the other major indices. Mid caps and small caps, as I said, taking it a little bit on the chin yesterday. They opened strong, really went through a period in the morning yesterday where it didn't look very good. They were seriously underperforming, not just at that time, but throughout the trading day. I've talked a lot about how small caps and mid caps have been holding up really well versus the NASDAQ 100 on an intraday basis if we ignore gaps. And that changed yesterday. We did see a little bit of rotation back away from the small caps. It'll be interesting to see with small caps gapping up again the most, whether or not that happens again today, or whether this time mid caps and small caps really grab it and run with it today. Transports dropped about 0.25% yesterday. But interestingly, if you look down below here, one of the leading industry groups yesterday was airlines. Airlines actually gaining more than 3%. So if it weren't for the airlines, we'd have seen maybe a little bit bigger drop in those transports. Moving on to the sector outlook here, or sector portion of this recap. Consumer staples gaining 1.1%. A defensive group actually led yesterday. But we saw 2 other very aggressive groups, communication services and technology, both having nice days as well, especially communication services gaining more than 1%. And as I look at these AD lines before I get into the industry group, you can see, look at the Dow. Can't go wrong looking at that one. How about the S&P? Right there with it, going to new highs. NASDAQ going to new highs. Mid-cap, small-cap still struggling on a relative basis in the AD area, which is kind of interesting because when I look at the intraday moves only relative to the QQQ, I'm seeing more accumulation, or apparently more accumulation during the day in both the mid caps and the small caps, particularly the small caps. But that's not showing up on the AD line. Just something to, I feel much better about it if the IWM AD line was setting new highs. That would kind of corroborate what I'm seeing in terms of the intraday accumulation that appears to be taking place. Transport strengthening, but still you can see well off their earlier AD highs from back over the summertime. So a little bit more work to do there. But look at the staples, communication services, technology, all these AD lines going up. This is a sign to me of additional or further accumulation in a lot of these areas, supporting these moves to the upside. Aluminum. Now, aluminum, we've seen quite volatile of late. It seems like aluminum's in our top three of the advancing or declining industry groups. It's been here quite often of late. Today or yesterday, it jumped almost 7% back to the upside, but you can see the volatility over the last month or so with the huge moves to the upside, followed by the really steep decline. Now we're jumping back up again, but you can see on the AD line here, not really showing a lot of accumulation. So that move to the upside barely got any kind of a jump, and we ended up going back down, setting a new low on that AD line. Just doesn't give a great, doesn't make me feel very good about this possible rally, or at least the attempted rally here in aluminum. Looking at mobile telecommunications, big move up yesterday, jumping more than 4%, setting a new high. Also, look at this AD line, much stronger. Then you've got the airlines, which wouldn't say it's in an uptrend, wouldn't say it's in a downtrend. It's just trying to figure out whether or not it's going to break above or below this recent consolidation. So I'm watching around the 158 level to the upside, and then to the downside, maybe around 137 or so. Let's see which way we go. Yesterday was a nice day, but we finished at 147, almost right in the middle of this trading range. And you can see the AD line not exactly exciting there either. So we've got some stronger areas for sure. Other areas need some work to do. And I would still throw the IWM in that latter category. We still got some work to do. I loved what we saw at the end of the year, the big move up to 205, which cleared like a quadruple top around the 197 to 198 area. So that was all good. Went back down, though, failed to hold the 20, did hold the 50, and did hold price support. And now we're starting to rally again. IWM is in the middle of its trading range between 187 and about 205, closing yesterday at 196. So squarely in the middle of that. Got some more work to do to prove that the IWM is truly uptrending and truly starting to show some relative strength. And that certainly has come into question with that recent downtrend. I still believe it's going to happen, but we've got to see it. Believing and seeing it are two different things. So IWM got some work to do, but I do like the way it's been trading the last few days, getting back into that routine of higher highs and higher lows. All right, moving on to the TNX. And I was just about to pull up. I had not looked at the economic reports yet. So I'm going to look at that with you here as we take a look at what's going on. Oh, that's right. We didn't really have much this morning. I'm thinking Thursday where we had the GDP and all. We have the PMI composite flash. That comes out at 9:45, so we haven't seen that yet. Consensus on the manufacturing side is 47.7, and on the services side is 51.0. So we'll see what happens with that later this morning. Let's see, what else? Let's just go on into the 10-year Treasury yield to give you an update. And so far, you can see that overhead resistance at the 50-day moving average providing some resistance. We did get up to 420, which was the level where we really took off to the downside. I mean, we've been going much, much lower in the 10-year Treasury yield since topping back in late October. That was about the time the stock market took off. So we had a lot of folks jumping into both the bond market and the stock market. That's what that tells us. When the yield's going down, it means Treasury prices are going up. Treasury prices are going up. Stocks are going up. I think a lot of that had to do with the inflation scare. I think this big drop right here, these 2 or 3 months, was finally the last of the folks who believed maybe we were going to have an inflation issue, finally saying, you know what, I don't think we're going to have an inflation issue. And as a result, began buying bonds at that 5% level, realizing that if you could lock in at 5%, that's not a bad deal, especially if inflation is going to be coming back down toward that 2% target that the Fed talks about. So all in all, pretty good action. I think that a lot of what we're seeing in other areas of the market are confirming what I've been talking about for a year and a half, that stock market's going to go higher. And it has. It's gone a lot higher. I think it goes even further. I do think that strength in 2023 is going to be muted somewhat compared to what we saw in 2024, I should say, is going to be muted a little bit compared to what we saw in 2023. But I still believe we're going higher, and it might surprise me. We might go higher than I think. I'm not ruling that out, by the way. Anyway, 420 to the upside on the 10-year Treasury yield. I think that's going to be a key resistance level to continue to watch. Even though it would be now above the 50-day, now we've got this recent high that sets resistance. So even a little bit of a trip above that 50 wouldn't bother me as long as the yield holds at about 420 to the upside. To the downside, I'm expecting eventually we're going to break back down below this 20, and that both the 50 and the 20 will begin rolling over and moving down together. I would look for the yield to move back down closer to that 380 level, probably over the next few weeks to a month. That's at least what I'm expecting. First things first, though, got to break below that 20-day. Right now, those who think the yield's going to continue to rise do have the short-term advantage because they're trading above, the yield's trading above that 20-day. Whether or not that continues, though, remains to be seen. I think we probably are going to get our answer with the GDP that comes out tomorrow morning. That can trigger a pretty big move in the 10-year Treasury yield. So if we are well above forecast, the 2.0%, which is forecast for Q4 GDP, the first reading, if we're much above that, I think we could you might see the 10-year Treasury yield break back above that 420 level. If it comes in weak, I think that's when you definitely would see a drop in the 10-year Treasury yield. So we'll keep an eye on that tomorrow and see what happens with that 10-year Treasury yield and the reaction that we get in the bond market. Moving on to the S&P 500, and you can see over on the right side of the chart, moving up to new highs, a new closing high yesterday on the S&P 500. Since breaking out back on Friday of last week, we have now seen 3 consecutive all-time high closes. And with futures looking the way they are, maybe today's number 4. Certainly going to get off to a good start unless something changes here in the next 18 minutes. We still have that negative divergence, by the way. And the way I play a negative divergence, see, a lot of traders, I differ from a lot of other technicians and traders in that they see a negative divergence, they run for the exits. The problem with doing that is you can miss out on continuing move to the upside because that's a warning sign that momentum is slowing, but you don't actually get the confirmation until you get the breakdown back below that prior breakout area. So until the S&P 500 were to close below 4,800, or another thing that would certainly get my attention would be a gap up like today. And if we saw massive selling all day long and we finished back down at 48.10, let's say we open today at 48.80 and finish at 48.10 and have a big red filled candle, bearish engulfing with that negative divergence, short term, I would say the odds move definitely with the bears. Right now, I'd say it's still, you got to go with the breakout. You got to go with price action. That's your number one. That's my number one indicator in the market: price and volume. Nothing else is close. Not divergences. Not rotation. Not anything else that I talk about. Price volume is always number one. You need to see a number of the other puzzle pieces start to come together. Like the negative divergence is nice. Hey, that could trigger a sell-off. Reversing candle off of an uptrend. Okay, then you got 2 pieces of evidence. A failed breakout. That would be a third piece if we can't hold 4,800. Lose the 20-day moving average. That'd be a 4th piece. They start building. Till you get that, right now, trying to take the negative divergence and use that as a weapon against an all-time high breakout, I don't think that's a fair fight. So we need something else. Let's look for at least a reversing candle, something that tells us that the bears may have gotten control after a nice move to the upside. And at that point, what I'm looking for is potentially maybe a 50-day test, which you can see the 50 days down at 46.50 and rising. So, I mean, that's, gets a little dicey if you think about where we are and you think, well, we're going up. Folks are turning bullish. More and more people are starting to turn bullish finally. But for those that are turning bullish, a 200-point sweep out from under your feet probably wouldn't feel very good. And that's potentially what could happen, but we need to see more. Like I said, based on what I'm seeing right now, I'd stick with the long side. I need to see more evidence of a potential reversal. NASDAQ 100, pretty much same thing. You see this push to the upside here, still got a negative divergence, but we continue to put higher highs and higher lows in. Yesterday closed at a new all-time high on the NASDAQ 100. Same as the S&P 500. And if we look at the Dow, which was down, the Dow was down yesterday, but the day before, Monday, we had an all-time high there. So when you're seeing all-time highs all around you, I really don't understand the bearishness. And I talk about that a lot. I won't jump into it again today, but I remain very bullish. And I'm talking longer term, because every once in a while I'll say, well, I'm a little cautious here, a little cautious there. Being cautious and being bearish are two different things. Being cautious is just understanding the market pulls back from time to time and seeing when the conditions are starting to ripen for a possible pullback. That's being cautious. That's saying, okay, the odds of it pulling back are starting to grow a little bit, and taking action from a trading perspective based on that increasing risk. It might be nothing more than say, hey, I got a little bit of this leveraged ETF over here. I'm just going to move out of it and go back to the regular ETF. That, to me, is responding to maybe a more cautious outlook. You're still long. I'm still long. You're not going to find me short. I've said it before. I remain long. I've got the QQQ, the Spider, the IWM, little piece of the TNA. But until we get big reversals or something to go along with this negative divergence, you're not going to hear me uttering too many bearish thoughts. And even then, it's not really, like I said, bearish. It's just cautious. So understand the difference. You can call for the market to go higher long term and be a little cautious in the near term. That's allowed. Anyway, transports. Transport's been making a move, which was nice because we did have that close below the 50-day moving average. Remember when I was talking about the transports having support at 15.2? Because I just said the TNX, the 10-year Treasury yield. Let me go back and show you that again. See, I said, hey, if we go back above the 50-day moving average, we still have this recent high. This is now a key resistance level right up there at about 420. So moving through the 50, a lot of people use the 50-day as it. You close above the 50, that's it. When I get a move and test the 50 and get up to a high and pull back, that 50 keeps coming down. If ultimately I get a move up through the 50, I still have to take out that recent resistance. Now let's go to the transports, because this is exactly what happened here. We ended up going down below the 50-day moving average, but look at where these tops were in this bottoming head and shoulder pattern. Left shoulder, neckline, head, neckline, right shoulder, breakout. Where'd you break out from? 15.2. Once you broke out, you never really, well, you did go back right here actually and test 15.2, and you held. That's the key support level. You broke out to a new high. You still have this as your support level. So here we come down, we close below the 50. Anybody using the 50-day as the key would have said, oh, transport's in trouble, close below the 50-day. What I said at the time was 15.2 is your key support level. So yes, we did go down below the 50-day moving average, but look at that nice little hammer right on that price support and then right back up. And that's something actually that I, as I got more and more experience trading, was something I started to see more often, because I in my past, probably 15 years ago, I did put a lot more emphasis on the 50-day moving average. And I still do. 50 days is a big thing. Not so much because I may not follow it from time to time. Like I said, 15.2 to me was the biggest support level here. But there are a lot of traders that use that as their line in the sand. And if you're trying to predict price action, you have to understand what most traders do. So anytime you go below that 50-day moving average, even if you have great support, you want to make sure you hold that support level and not really give it, more room to the downside, because the longer that stays below the 50-day moving average, I think the worse it is technically. Let's move on to the to earnings beats. Let's go ahead in here for the chart of the day. So first, for those of you who are new to the show, welcome. Always appreciate new folks coming in. Tell your friends about us. I think we take a completely different look at the market. I think our track record has definitely spoken for itself over the last half dozen years. And we've gone through a lot, starting back with that 2018 trade war, going and right up into the pandemic, the 2022 cyclical bear market, all the myriad of reasons why the market can't go higher. And yet here we are, just continuing to set new all-time highs. You have to understand what a secular bull market looks like. You have to keep perspective in mind, and you have to remain objective. It's really funny. I love it when folks say that I'm not objective. I think the proof is in the pudding. Do you call bear markets? Do you call bull markets? Can you go both ways? If the answer is yes, then I give somebody a lot more credit personally than if they're always saying the market's going to go up or they always say the market's going to go down, because the market doesn't always do anything like that. It's always doing different things. You got to do research. You got to find reasons why the market does what it does. Anyhow, if you are new to the show, I hope you enjoy it. Keep checking us out. I think, there is a lot to learn about the market. We try to use this platform as an educational platform primarily. Obviously, it's a marketing platform. We'd love to have you come in and try our service. That's what keeps us doing what we're doing. If we didn't have paying subscribers, we wouldn't be here. But anyway, check out. We have a 30-day no-cost trial. Love to have you come on board. As I mentioned earlier, we have our live trading room that starts in about 40 minutes. We do it every Wednesday at 10 a.m. So a 30-day free trial will get you into our next 5 live trading rooms Wednesday mornings. And again, 10 a.m. Eastern. Also, if you're new, we have a free newsletter. Cost is $0. Name, email address. Hit that subscribe button. You're in. 3 times a week newsletter. Just wrote an article this morning right before the show on Raytheon. I'm going to show you that chart in just a minute. This comes out 3 times a week. Again, it's very educational in nature. It talks about a lot of the things that are important to us at EarningsBeats. It talks about relative strength. It talks about earnings. It talks about gaps. It talks about price volume. It talks about sentiment. It talks about other areas of the market, some of the signals that we use to help us gauge the market in both directions, moving to the upside or potentially moving to the downside. We feature all of those things. So make sure you check that out. You can unsubscribe at any time. And for this free newsletter, there's no credit card required. So I don't know why you wouldn't want to check that out and see if it can help in your trading. So today, I think I might have we're not looking at TRX gold. We're looking at RTX. Typo. RTX, so Raytheon. And I'm going to annotate this for a second just to show you a couple of things I'm looking at here. First of all, right there, you see this gap down. Look at the volume. That was the biggest volume of the entire year. And it occurred with its earnings back in July. I don't recall what the earnings were. Obviously, the market didn't like it. So I'm assuming a miss. It could have been lowered guidance. I don't recall. But what I can recall, just by looking at this chart, is that there were a lot of folks selling that day. Had a big intraday move to the downside. We did come back up, print a hammer, but that didn't really keep the bulls motivated for very long. We can see that we had a reaction high back up to about 87, and then that we couldn't get through that level and then went back down and set a new low. So this line right here goes in as the reaction high. So after gapping down, this was as high as we could get before the sellers took back over again. Big red filled candle there. I mean, that's just ugly. So now we got 2 key levels. Well, here we did break above the reaction high yesterday on heavy volume. Did have a nice gap up, traded up intraday near 92.5, and then came back down, closed below 90, but we managed to hold on to at least this first breakout level. But there's a third level in here that you need to be aware of, and that's broken support becomes resistance. So when we gapped from $96 down to about $86 or $85, this prior low, which was support, now becomes resistance. So now I'm looking at 3 levels on RTX. for this stock to become relevant, we need to see it take out all three levels. I mean, it could turn at any of these three and move back to the downside. Now, we cleared one. I am a little concerned by leaving a long tail. We had something happened. I don't know what happened yesterday. Maybe it was earnings. I didn't see the earnings. If it did, actually, I think it might have been earnings on our RTX yesterday. Anyway, we got that gap up. We did get through the first level. We were through the second level intraday, and then we reversed and failed to hold it on big volume. So there was a lot of sellers out there as well. So do we negotiate 91? That's going to be the first test. The second one's going to be just above 95, maybe around 95 and a half. Can we get through both these levels? If not, could be more of the same. We might go back down to the lows. We might go sideways. But I would not treat this as an uptrending stock at this point. I think there's still too much overhead resistance for me. I think there's a lot of other stocks out there that don't have this kind of restriction overhead. And so those are the ones I'd be more inclined to trade. Here also, look at the bottom, the AD line. I mean, we now just moved to an all-time, well, not all-time, but a 52-week low on the AD. So it's not really showing signs of accumulation. What you normally see when you get these moves to the downside in the AD line is you get a lot of days where you're leaving tails to the upside, meaning intraday moves were much higher than closes. You end up coming down and closing within the bottom half of the trading range for the day, sometimes all the way down at the bottom. I mean, if you look, looks like maybe January 17th, which would have been last Tuesday or last Wednesday. We had this move up testing this price reaction high. And then we came all the way down, closed near the low, right on that 20-day moving average or close to it. So that, January 17th was not a good day. And you can see that the AD line takes that drop. That's what happens. That doesn't give you a good feel when a stock goes up intraday and then comes back down and closes on its low, especially when it seems to have a pattern of doing it. So RTX, I look at it, I see the big volume, I see the gap up, but I still see a lot of issues, a lot of clouds on the horizon. I think RTX has some work to do. That's my point. So yes, if you're looking at a 6-month chart going back maybe to July or whatever, this probably looks like a much better deal because you're breaking out now to a 6-month high. But when you pull it into a daily chart, you can see a little bit different. And I haven't looked at the weekly, but let's take a look at the weekly and see if the weekly tells us anything else. Weekly tells me that during this massive bull market run, especially look at 2023, we had a big year, 2023. Raytheon was at one point down to $68 a share from a high earlier in the year of 106. That's a steep drop during a period when the market's going up. So yeah, we're getting a little bit of a rebound, but we're still trading where we were probably back in 2021. We're now 2 full years since then and a partial third year, and we're still trying to get back above where we were then. Doesn't make a whole lot of sense. Doesn't make me feel good. Now you go to the monthly chart and you'll see a better picture. This is a stock that tends to trend higher. And if you drew a trend line, you'd say, hey, we're probably closer to the bottom of the trend line than the top. So maybe a long-term investor might like this, the recent pullback that it had in selling, knowing that the long-term track record has been pretty strong. So you can look at different time frames and come up with completely different views on the stock. And as a long-term investor, if I was buying because the stock shows a really nice long-term history, maybe pays a nice dividend, these pullbacks to me would be great entries for a long-term trader, somebody who likes to buy and hold for the long term, realizing that, yes, these companies may not be Apple and Microsoft or NVIDIA, where they're going up 5 times in a year. That's NVIDIA, by the way. But they're still steady growers, and you want to protect your capital. You don't want to, if we do go into a recession, chances are Raytheon's going to hold up a lot better than NVIDIA. So you've got that going for you. Anyway, again, it really depends on who the investor is that's looking at the charts and what your goals are. Some might look at Raytheon and say, hey, this is the best stock to buy, not NVIDIA. Other growth investors who've been in NVIDIA would probably disagree because NVIDIA has been out absolutely crazy. But again, looking at different time frames, looking at different stocks and looking through different, different glasses, different goggles, makes a big difference in what's appealing and what's not. All right, I wanted to talk. It's 9:30. Netflix came out. I'll show you the open here in just a minute. But Netflix reported. This is interesting, by the way. So Netflix reported an earnings miss. They did beat revenues, and their subscriber numbers were off the charts to the upside. And honestly, subscribers is probably a better number to invest off of than the earnings per share. I mean, subscribers are kind of a leading indicator of what their revenues and profits are probably going to look like down the road. And they blew the number out of the water on new subscribers. So in my opinion, it was a good report on Netflix, even though they did miss. They came in $2.11, and they were expected to come in $2.20. And so that earnings miss, what does that get you? Well, let's get an update. It's still not showing the update yet on Netflix. Let's go into the, nope. Maybe I'm ahead. Anyway, right now it doesn't show, but Netflix was up $50 pre-market. Actually, we can take a look at that. See if we see it here. Doesn't show it here and doesn't show it on the chart. I'm not sure what's got going on. Maybe we have a little delay at stock charts, or it could be a data feed going into stock charts. Anyhow, SAP was another one though. SAP, that's the second largest market cap company to report yesterday. Netflix was the number one. Whoa. After hours yesterday. Let's just say after hours yesterday. Netflix was number one. SAP was number two. And they both missed. SAP missed 152 versus 164. And I think I saw SAP was up like $12. And that, okay, it is showing there. So SAP, you can see up $11 right now. They missed. So the two largest market cap companies to report yesterday after the bell both missed their earnings estimates, and both up significantly this morning. And then you've got Texas Instruments, by the way, that beat their estimates, and the stock's down 2% or $3. And you wonder why folks can't understand the stock market. You know, when you look at some of these things, it's difficult to disagree with them. I mean, sometimes it doesn't make any sense, but a lot of times it's what Wall Street has anticipated, what's been built into the stock. Obviously, with Netflix, Netflix been going sideways for a couple months while the rest of the market's been going up. Many of the other high flyers have been going up. We got some good subscriber numbers, and now quickly, obviously, Netflix playing catch up. Anyway, pretty good action there. Let's take a look at the overall market and then wrap up. Dow Jones up 132, S&P up 25, NASDAQ 120, small caps up 11. Looking at it on a percentage basis, small caps do have the lead, but looks much narrower. Now, I was looking at the IWM earlier, so let's see what that's showing. And that is showing up 0.8%, and it also is down from its opening gap. Once again, just like yesterday. Did not put in a higher high yet, by the way. So we'll see whether or not this tops things off for the small caps, or do we go back through later today? I don't know. We'll see. But at least in the morning, we're doing similar to what we did yesterday. Here was the gap up, and you can see selling throughout the first couple hours. And then we started to come back. Notice the low intraday from back on Monday held yesterday on that pullback. So that's an area I certainly would watch on any selling today on the IWM, somewhere from that 194, 195 level. And I believe, let's pull the daily up. Yeah, 194, 195, that's exactly where the 20-day moving average is as well. So if the IWM goes down, closes back below 194, probably going to go back down and retest the lows. So that's why I would be watching 194 pretty closely. Anyhow, that's it for me. I'll be back in about 25 minutes for the live trading room. Again, hopefully many of you, if you're not already members, take us up on that 30-day trial. Come on in. I'm going to be taking a look at a lot of earnings reports at 10 a.m. this morning, a bunch last night, a bunch more this morning. And so that'll be a focus, at least at the start of that trading room. Have a great day, everybody. I'll be back tomorrow at 9 a.m. for your next Trading Places Live, and that's 9 a.m. Eastern, of course, and would love to have you. Click on the like button and subscribe to our channel if you like what's going on, if you follow the show. We'd love to have that support. It'll certainly help us on YouTube. Have a great day, everybody. Happy trading.